following this week's Fed rate hike, our next guest says that he's keeping an eye on what's rising interest rates mean for the U.S. dollar. Joining us right now is Henry Mallari-D'Auria. Did I say that right?
Very well.
Mallari-D'Auria?
Exactly.
He is the Chief Investment Officer of Emerging Markets Value at Ariel Investments. And Henry, thanks for coming in today.
Well, thank you for having me.
So we made it through the bulk of earnings season at this point. We've heard from the Fed. We know what they're doing next. Why is it that you're now focused on the dollar?
Well, I think what we've seen in the past is the moves in emerging markets have a lot to do with U.S. dollar movement. And that's related to capital flow, right? The U.S. has been attracting a lot of capital from investors. A weaker dollar has the potential for changing that capital flow direction.
Okay, and that means what in terms of what you do with your money?
That you should have some non-dollar assets and maybe some faster growing economies like some of the smaller emerging markets.
Which ones are you focused on?
Well, we like Vietnam, we like Philippines, we like Brazil. These are markets where inflation is from different sources, right? Food inflation, energy is a bigger part of the basket. There's still a lot of slack in the labor markets. So that part of the inflation source is very different from the U.S. And that could be at the heart of what causes the dollar to weaken, is that we have labor inflation higher here than in other parts of the world.
Is your thesis that we've seen the bigger gains here in the United States and that's not going to continue later, or you just think other economies are poised to maybe outperform?
The U.S. has seen a lot of economic growth, which is why, right, we've got the tightening. In emerging, it came out of COVID later. There's a lot of easing still underway. That's why GDP growth is expected to accelerate in many of these markets. And that's the reverse of what's happening here in the U.S.
Okay, so one of the stocks you like is SK Hynix that competes with Micron and Samsung. What, they do memory?
They do memory. They do it well. 96% of memory is produced by those three players, and they're acting in the oligopolistic manner that you would think, right? There had been weak demand. It brought DRAM prices down. They've, in aggregate, cut 20% of production, and in aggregate, they have cut 50% of capital spending projections over the next 2 years. So we are likely to see tightness.
Why cutting the capex? Why are they doing that?
Because at today's DRAM price, it doesn't make economic sense. The returns are too low. So they're reacting the way you would hope. There could be some further upside if we actually get AI-driven acceleration in demand for memory. But in the meantime, they are reducing the growth in supply, which should lead to tightness in any case.
Okay, another stock you like is KB Financial. That's the largest bank in South Korea.
Largest bank in South Korea, priced at 0.3 times book.
Why?
And normally, right, do you get 0.3 times book when there's an asset quality problem?
Right.
Bubbles happen, though, after fast growth, and there has not been fast growth in Asia, particularly in Korea. This is really an issue around how will company managements use excess capital. And they just reported this week that not only are earnings growing stronger, but they're going to buy back stock.
But the asset quality isn't a concern there?
Asset quality, there's been some growth in consumer lending over the last few years, but it's hard to have an asset problem when loan growth has been 3 to 4%. And when mortgages are done at loan-to-value ratios of 50%. There's excess reserving, excess capital in the system. This is really about people wondering when there will be a quicker pace of growth.